Recording in progress.
Okay, good afternoon, everyone. Thank you for joining today's webinar. Today, we're very happy to invite Fidelity International to give us this webinar. The topic will be Global Dividend Fund Investing Through the Lens. Global Dividend Fund Investing Through the Lens, the case for dividend investing. Okay. And today, very happy to invite our guest speaker, Mr. Jonathan Leong, who is actually an Associate Director with Fidelity, to give us his talk. Okay, over to you, Mr. Jonathan.
All right. Hi, good afternoon, everyone, on this very rainy day. Perhaps I could just spend a little bit of time while we begin to just sort of do a very quick introduction to Fidelity, right? Because I know that there are so many asset managers out there, and I just thought, if I could just summarize very quickly what differentiates Fidelity International from all the peers out there, right? Because I think when I talk to, let's say, peers of mine or friends of mine or family members, oftentimes they don't really know what's the difference between one asset manager to the other. So I'll just do a very quick one. The three things that differentiates Fidelity International from the rest of the pack would be, one, that we are a private company. So this is quite important as an investor to know. We are a private company. We are majority family owned by the Johnson family, run out of Boston in the United States. And we've got a very, very long history of investing. So why is it important or why is it interesting to understand that we are a private company? Because as a private company, we do not have floating shares. No one outside of the firm owns the company. We have no shareholders. And this is quite crucial because if you look at a lot of what happens where there are companies with stocks out there in the market, typically the focus would be an increasing share price, right? So you would see sometimes there's a lot of replacements in CEOs or senior management because share prices do not do as well as what stockholders expect. Now, we do not have that problem because we do not have shares out there. Now, this is crucial because it allows us to be completely aligned with the most important stakeholder that we have, and that is the people who trust us with their money. We run money for governments, we run monies for individuals, we run monies for countries and institutions. So for us, that is the most important thing. We are not driven by stock prices, and that's what one main point that differentiates Fidelity. Number two, we are an independent business. What I mean by that is investments are our only business. It's our bread and butter. You're not going to see other associated businesses such as a Fidelity Bank. There is none. You do not see a Fidelity Insurance Company, of which sometimes I guess it could be an advantage or a disadvantage if you had such a diversified business as an investment firm. Let me give you an example, right? So if I at Fidelity, when we decide to launch any new investment solutions to the public, what we have to do is we need to make sure that we go out and sort of prove our worth to our distributors, to our investors, to the people who entrust us with their monies to manage. However, if we had a lot of linked businesses, if we had a Fidelity Bank, if we had a Fidelity Insurance Company, it would be typically a lot easier to raise money because we have a sister company of sorts, right, that's ready and waiting to support and give us money to run. So for us, number two, an independent business. I think this is also quite crucial because you know that we have no associated businesses. We really have to stand by the most important thing, which is our investment capabilities, our commitment to clients, and of course, our long-term performance of the investments. The proof is in the pudding in that sense. So that's the second point. First being private, second being independent. The last one is research driven. So being a private company, being an independent company, where do we decide to put our resources? Where do we decide that to differentiate ourselves? And that truly is with our research. So we are very much an active management firm. If you look at Fidelity over the last few decades that we've existed, you will see that we've got a lot of superstar managers, people from the likes of like for Fidelity Investments, we've got people like very famous Peter Lynch, Joel Tillinghast. A quick Google will show you all these names. Will Danoff, Daniel Roberts, the guy who manages the fund that I'll be talking about today to share this idea with you. So as a research-driven company, what we want to do is to dig and look for great investment ideas that are, number one, not really well known out there in the market. And number two, we want to make sure that we hire the best and brightest to make sure that we can beat the market, basically, over the long term. So these 3 points: private, independent, research-driven. We have a team of what should be the largest investment team out there in terms of analysts, fund managers, the folks that are actually doing the analytical work to decide where to put our clients' monies to work. So with that, if there's a very quick summary, maybe I can just move on to introducing myself. My name is Jonathan Leong. Very pleased to be here with you today. I am Associate Director for our Southeast Asia business here. And it's our job to ensure that our clients get the best of what we do in terms of the wholesale of distribution landscape. And we're very pleased to have Philip as a partner, Philip Securities as a partner. And many thanks, Daniel, for having us here today, having me share today. So what's the topic, right, of today's sharing? Today, we're going to talk about, as you can see on my screen, our global dividend fund. Now, this is a flagship core global equity fund that we've got on our shelves. It's been in existence for more than a decade now, so it's got a pretty long track record and a very strong track record as that. So a lot of times, folks sort of have questions around what is dividend investing, when is dividend investing good for a portfolio, and how can they think about what are good ideas at this point. So maybe as a quick summary of what I'm going to be sharing today, first I'll talk a little bit about the macro backdrop, meaning to say, what's the economic landscape like? What are we seeing in terms of data? What are the trends that the governments are looking at? What are interest rates going to do? And then after that, we'll talk about what is the case for dividend investing. Does it make sense now, or is it always a sort of evergreen investment strategy? How does it sit within a portfolio? Oftentimes it is the most sexy stocks, the stocks that are most expensive, the investments that have made the most money in a very short period of time that tends to make the headlines. And for dividend investing, typically that's not the case, right? I think maybe a lot of you already invest in individual stocks, for example, which maybe as a quick disclaimer, I'm not allowed to talk about individual stock recommendations in a public webinar. So if we're looking at investments in individual stocks, for example, if you have a lot of the Singaporean investors that I meet, they do buy into our Singapore telco stocks. They do buy into our bank stocks. And often I ask them, why do you buy into these companies, right? Why do you buy stocks from the local banks? Why do you buy the stocks from the local telecommunications companies? And inadvertently, a lot of the reasons are because, number one, it's very stable. They tend to be very stable over time, meaning to say the stock price does not fluctuate with huge waves, huge drops, and huge increments as well, right? So less volatile. The second thing is the predictability of dividends, meaning to say they have these stocks do pay a regular, sort of predictable cash flow on a monthly or quarterly or whatever it may be, depending on the stock, to the investor. And so with this concept, you sort of understand what I'm going to talk to you about today. in terms of what is dividend investing. Because if you look at the fund that we are sort of introducing and sharing today as one of the ideas for an investment portfolio, we always talk about investments from a portfolio perspective, right? The Global Dividend Fund is merely a global fund that has lots of these lower volatility, better valuation, and consistent dividend paying stocks. So like I mentioned, we are a research driven company. The fund manager, Mr. Daniel Roberts, who's run this fund since its beginning, right, in early 2013. This fund has been around for about 10 years plus, and he's been the lead manager through and through. And yeah, so I would say that that's a very quick intro to what dividend investing is. And without further ado, maybe I can just jump in and do a very quick whistle stop tour about what we are talking about here in terms of the current macro environment and what its relevance is to global dividend investing. So what's the case, right? Why are we talking about this at this point? If I can just do a very quick 2024 sort of macroeconomic overview, what we are seeing today, the picture that we are seeing today is actually starting to, we are at a turning point. And what is this turning point, right? We finally seen over the last 4 years, interest rates have been moving super fast, super high. I'm on a floating mortgage, so that has hurt me tremendously. And it's been very painful. But finally, we've seen that the Federal Reserve, the central banks, the central bank in the US, Fed Chair Mr. Powell has announced rate cuts. Now, this is a turning point, right? Because for us, we see that inflation is no longer an issue. Looking at the data, it's meaning that it's not going to get worse. Inflation is not going to increase. And if you're looking at the base case, we do expect there to be a nice, but perhaps a soft landing. We're going to see things slow down. There's some risks ahead, of course, political risks being one of them. How is China going to evolve? And because China is a very big player in the global macroeconomic scene, right? But when we are looking at interest rates, we expect further cuts from the Fed. And risks of cuts would also mean that in the event of a short, there could be a avoidance of a very sharp slowdown in the US, because we do see that unemployment is quite high, and the Fed has this dual mandate that also needs to manage not just interest rates, not just inflation, but they also want to manage the economy to have a soft landing. Unemployment was quite high at the last reading. So for us, we still see sort of a mixed picture, but rates are going to have one direction, they're going to move downwards. The market is expecting rate cut expectations of about like 4 times the end of the year. There are another 4 more Fed meetings, so we do expect that there should be some cuts moving forward. Now, why do I bring this up, right? It's because it's going to be quite important when you think about dividend investing with this macro background. If you are looking at, let's say the next slide here, if you pay attention to some economic data is starting to look a little bit less positive. So if you look at this trend line, and we took this data from CD Investment Bank, you can see that economic data is moving downwards. The red line is trending downwards. So this does not mean that we are expecting a recession. We are not. But what we are expecting is a slowdown in growth. Things are going to be a little bit tighter. We also saw the yield curves, start to steepen. In short, there might not be, very bright skies ahead for the overall market. And I think this is not going to be a surprise to you. Living in Singapore, if you listen to what PM Lawrence Wong was talking about at the budget, you can also sense that, Singapore as an economy watching as an audience and a participant in the global economy, we are giving a bit more of a cautious overview that we need to be careful. There could be growth, but growth is going to slow, right? So you do see similar rhetoric, similar narratives when we are talking about that macro view. And if you're looking at the next, what has happened in the markets? So we've moved from the economy, and I'm talking a little bit more about the investment world, right? The stock markets itself. The rally over the stock markets have done, if you look at overall stock markets, they tend to have done really well over the last couple of years, right? But why, right? Post-COVID. And it's been mostly led by tech stocks, tech-related stocks. It's been led by mega cap stocks. So meaning to say like your Magnificent Seven, of which I'm sure you might be quite familiar with, these 7 stocks that have just, they seem really unstoppable over the last couple of years when interest rates were moving up, when growth expectations, work from home, adoption of technology, things moving to online, these stocks just seem to, have a great time. And now we are sort of seeing this trend sort of buck. We are seeing the trend start to reverse a little bit. This trade has become very crowded. As a firm, generally speaking, and even as a fund that we're talking about here today, we have been underweight the Magnificent Seven. We find that it's very expensive. That as an active research firm, we are very conscious of valuations. So for us, those were very crowded, very expensive spaces to be in. Equity markets actually saw utilities, staples, sort of like bond-like boring companies actually do really well this year. And this is also off the back of the fact that there are expectations of growth slowing, like I mentioned earlier, right? So if we think about this big picture, what can we see on the flip side, right? The market breadth, meaning to say the number of stocks that have actually started to do well has dispersed. We're not just seeing the Magnificent Seven hold that crown, that small number of stocks pulling the stock market up and above, right? Meaning to say, if you did not own those stocks, you didn't make as much money. But you now see that there's this rotation that's happening. So if you look at the lines here, right, if you just pay attention to the left-hand side, you will see that there has been a bit of a switch in terms of which countries have done well and which country markets have not done as well. But more importantly, if I want to bring your attention to the sectors that have done really quite well are your more boring sectors. Ever since June, second half, July, that point till today, you see utilities companies, which are your very boring sort of utilities, right? Think about your PUB, your PUBs of the world. And if you look at staples, meaning consumer staples, consumer staple goods, you think about your daily necessities, think about things that you really can't do without. Even if you wanted to tighten your belt, you will need to buy your staples. So you think about, let's say, your daily necessities, right? Shampoo, soap, toilet paper, things like that. Global staples have actually been doing pretty well. And this is a stark difference to what we saw in the last couple of years, which we find is quite encouraging because it's always quite dangerous when markets start to build a bubble. And there was very much a bubble in that sort of Mag 7 space. And if you look at something that's quite important to us as well, earnings, right? So fundamentally speaking, a stock price should do well only if they're making money. If the hype is more than their earnings, typically that's not a great investment in the long term, because if the company cannot deliver on its hype, and we've seen many of these before, the stock price is just not going to go anywhere. In fact, it could fold and the company could close down, right? So if you look at earnings trends on this chart here, you will see that the Magnificent Seven, which is the blue line, you can see over the last 5-6 quarters, the trend line has been coming down. Their earnings are not as great. They're not quite doing earning as much profits as the market expected them to. But if you look at the orange line, you will see this is the S&P 500 without the Mag 7, and you can see a steepening earnings trend, which are quite early days, and we find this pretty encouraging because it means that there's a sort of a normalizing of the market, where we are seeing things sort of, the people's fever and hype that they're coming down on things like ChatGPT or all this AI stuff. It might sort of normalize. We don't think that it's a bad trend. We do think that AI is here to stay, but is it worth all that much? Should these stocks be running up so much, right, in such a short span of time? So what's happened? What has happened? What are the opportunities that we see, right? Given that the market breadth has sort of dissipated, that other stocks are doing quite well, and we do see a bit more of normalization as growth starts to slow, as concerns start to build, right? After such a high interest rate hike cycle in the last couple of years, it creates more opportunities for other companies, which is great for an independent stock picker like us that goes around looking for companies outside of just the Mag 7. Non-US stocks have actually become a lot more attractive in terms of price, And let's just go back to fundamentals of investing, right? You want to make sure that you are doing one thing consistently. You want to buy low and you want to sell high. So lower valuations in non-US stocks and lower valuations of US stocks that are not in the Max 7 that we see opportunities in, those are actually creating a lot of opportunities for us, and we have been uh, taking action and buying some into our portfolio so that we can benefit our clients. So this is sort of the trend that I've been talking about earlier, macro, what we see, what do we think in terms of the economy, what do we think in terms of the interest rates, and how are stock markets shifting or how they have already shifted. Now, if I bring your attention to what we are talking about today, right, which is anchoring on dividends in sort of what could be quite uncertain times and when growth is slowing. Maybe I can just cover very quickly what are the benefits of dividend investing. I've spoke a little bit about this earlier when I talked about a lot of folks buying, the local telcos and the local banks. You get stability, you get a stream of income, right? If I bring this from a global perspective, number one, you can see dividend investing gives you defensiveness in your portfolio. Now, we are all investors here for the long term, right? We want to make sure that our investment portfolio is going to do well for us to meet our needs and goals for the long term. So in a core equity portfolio, it always makes sense to have some defensiveness in the portfolio. You do not want your investment portfolio to be so high risk such that you experience such high volatility. At least for the average individual, that's not something you're looking for. Because if I can give you an example of a very aggressive portfolio, imagine if rewind your life to, let's say, pre-COVID, and you were only investing in extremely volatile markets, like emerging markets, like China. Maybe if you're looking at tech names, very high growth sectors, during a time where you saw massive slowdown and panic, which was what happened during the COVID crisis, you saw how these stocks could become so volatile and the speed at which they fall. I don't think that's something that a lot of investors want to stomach, right? Especially if you need liquidity, if you might need to use that money sometimes to pay for education, for your daily needs. You do not want to be materializing your losses at such a period, right? China saw such a huge slowdown, and stock markets have also, sentiment has been quite poor as China restructures itself. You want to have some defensiveness. I guess that's the point I'm trying to make. And defensive stocks have been proven time and time again, as you can see here in the shaded bars where you see an uptick in performance. Defensive sectors tend to do really well when markets slow down, when there's shocks in the market. So it's always prudent to have dividend stocks that are defensive, that give you that quality in your portfolio. When your tactical, high growth, riskier assets fall, you have something else that can, balance that out. And dividend investing tends to do that quite well. The second thing that's a benefit, it would be your dividend. Your dividend stocks can tend to also be a lot more resilient. So if you look at this chart here, right, it just shows you on the left hand side companies that have been committed to growing dividends over time. A lot of them are called dividend aristocrats. You can see that dividend growers have outperformed the S&P 500 over a longer period of time. And you can see here this chart, of course, it's a very long time period, but you can see that there's quite a bit of divergence from what you're looking at in terms of dividend growers, the blue line, dividend aristocrats, versus the pure just dividend payers and your normal S&P 500. So you're able to sort of do better over time from that compounding effect that dividends pay, plus you also get stability, and that's reflected on the right hand side. So if you look at the right hand side, this is a measure of volatility, meaning how risky is the portfolio. It's not a performance chart. It's not about how much money you make. It's about how stable the portfolio can be if you had dividend stocks. And the blue bars show dividend stocks versus just a regular index, which includes dividend stocks and non-dividend stocks. And you can see the trend, be it 3-year, 5-year, or 10-year, the risk that you are taking across time periods when you invest in dividend stocks, they're actually lesser. Your portfolio becomes a lot less volatile. And this is something that I think is a benefit, especially for portfolio number one, but it's especially a benefit when we're expecting growth to slow. And that is also one of the reasons why over year to date, especially in the last couple of months, you can see like boring stocks, dividend paying stocks has actually done quite well relative to all those high growth stocks that were the darlings of the market in the last 4 years or so. The last thing which I would show is the impact of dividends to your total return as an investor. So if you look at this chart here, this graph, you can see that there's two colors, blue and orange, right? So if you combine the both, that is your total return. If you invest, you get dividend returns and price returns for both. However, if you look at the volatility in the blue side, just relying on capital and price returns can be quite volatile for your portfolio. But dividends, when they are paid, they are a very positive addition to returns. In fact, over a longer period of time, because the power of compounding, you can see that dividends actually make up a very significant amount of total returns. So these are the three main points that I wanted to just point out in terms of the benefits of dividend investing. And I hope that, given the macro environment and given the broader picture of investing in a portfolio, you can sort of appreciate why it's important to have some dividend stocks in this environment, and I would say beyond, right? I think it's quite important to always have that defensive element in your portfolio, because after all, no one can tell the future with great certainty. If you're looking at a source of income, so this chart, as I mentioned earlier, dividend investing in terms of getting income is really quite attractive for a lot of investors, because either they can reinvest the income and compound returns, or there are some daily needs and necessities that they would like to have a regular cash flow from their investings, just to make sure that they can pay for whatever it may be, right? School fees, mortgage, petrol, whatever it may be. So you can see here why this is quite important, because like I mentioned earlier, we are now in a new phase of interest rates. Interest rates are starting to come down, which also means fixed deposits are also coming down. In fact, fixed deposits come down at a much faster rate than where the banks expect interest rates to go. So if you just go walk into a fixed deposit, time deposit, when you talk to a bank now, it's become a lot less attractive. Similarly, mortgage rates are also coming down. They're all related, right, to interest rates. But what's important is that in a lowering interest rate environment, dividends become even more important, because if you're investing in companies that pay a consistent dividend, that pay a increasing dividend, that grow their dividend, you actually get more bang for your buck, because time deposits go down. Where are you going to get that passive income from? Dividend stocks become even more important during that period. So if you look at this chart here, you can see if you're looking at stability, it's important to find stable payouts when you're searching for dividend companies. And then I'll go to that later. What is the Fidelity process in the Fidelity Global Dividend Fund to sort of narrow the scope, right? And pick what we think would be the best for the portfolio in terms of getting some growth, so sort of keeping pace with the market, getting a good income, as well as providing the portfolio with some stability as well. Let me just move on very quickly. There are some questions which may come through your mind. What are dividend stocks? What are the kind of dividend stocks that we might want to pay attention to? Now, I'm not allowed to talk about stocks, so I can sort of talk about what we have in our portfolio. What are the kinds of dividend stocks that we could own? Because to us, it's not just dividend investing does not mean that you're just buying into boring stocks. It doesn't mean that you are just buying into companies that are not going to go anywhere. I had to remove all the logos from this slide, so I'm not supposed to. I cannot mention the companies that I'm talking about, because these are not stock recommendations. They're just sort of what we have owned and maybe still own in our portfolio right now. So if you look at the first column, right, we do own. There are dividend companies, and we do own them in places like information services. So an example of a company that we like this would be a company that provides information services to professionals. So we do invest in a company that supplies journals, medical journals, software journals, very industry-specific academic and research material. And this is on a subscription base. They have an extremely high recurring revenue, because you can imagine hospitals, private practices, doctors, etc. When they pay for a subscription, they need this information. They want to read this information, and this is one of the leaders in that legal, medical, IT tools and software sort of academic journals that they produce. And once you're on the subscription model, your earnings are quite, the company's earnings are quite predictable. Just think about for yourself and for myself, right? Just because we don't watch Netflix and we have a Netflix or Spotify subscription, maybe this month we're on holiday, we don't cancel our Netflix subscription, right? For example, even this, if this month we're busy, like for example, for me, I have a Netflix subscription, I have a Disney subscription, I have a Spotify subscription, and recently I just welcomed a newborn in the family, so there is no time to watch movies or really listen to music, but I still keep my subscription going on. So therefore, we do like companies that have a subscription service. This is one of them, and we have owned this stock for quite a long time. It is a very attractive company to us still, and they do grow their dividends. Another sector that we quite like is the healthcare and pharmaceutical sector. As you can imagine, a lot of the healthcare pharma sector, they're considered quite defensive in nature and quite regular, because you don't stop buying cancer drugs, you don't stop buying your diabetes drugs, your blood pressure drugs, or your thyroid medicine just because you are making a little bit less money, right? Your health is always so important, and it doesn't mean that when a recession comes, then you're going to stop taking medicine. That's not the case. So there's a very low sensitivity to the economy. We own quite a few pharma companies, and a lot of them are they either have strong patents in their product line, or they are also there to make sure that they are able to provide good services and continue their research. I do see a quick question that has come up in the Q&A. I can address this now. Question is, it seems like pharma has been diving down in the recent weeks. Yes, selected counters have been seeing some volatility, and we do expect volatility to come in a year where there's US elections. However, what I'm trying to say here is, again, to the point, we're not looking at the short term here. If we are researching a strong company, and in this portfolio, we only own about 50 stocks, 30 to 50 stocks, 40 to 50 stocks, we are looking at investing in them in the long term. We're looking at investing in these companies for a long period of time to collect their dividend, to be with them when they grow their dividend so that we can pass this on to the consumer. So for us, if we do have a company that we like and the price goes down, we tend to buy. Going back to what I just mentioned, it's really important to remember fundamentals, right? We want to buy low and sell high. Yeah, so that's sort of a very quick way to answer your question here, or your observation from the Q&A. Another company that another sector that we look at is the consumer staples. So if you think about it, this is the company that I'm talking around here is well stocked in any of the supermarkets that you can see globally. They're the world's largest consumer product manufacturers. They manufacture things from paper goods to personal care to shampoo, and developed markets use their products, emerging markets use their products. Everyone uses their products. In fact, a lot of these companies have different tiers. You know, for example, if you buy a hand wash, they have a luxury line. They also have a very basic line, right, that you can find in your public toilets. So consumer brands, these are companies that we like. And the point I'm trying to make here is that a lot of folks think that investing in dividends or investing in with a value hat on is a value trap. Not necessarily so if you do your research. And if we're looking at companies that have strong top line, strong market share, brand leaders, we have been able to avoid value traps in our investing style, in our portfolio. The last one, but not least, is also sometimes it's quite surprising to folks who look at us, our portfolio, and they say, oh, it's so interesting. You also invest in cyclical sectors or in IT sectors. Yes, we do. Semiconductor industry is actually one of the more exciting parts of the portfolio. And I think we all know what semiconductors do. Basically, any smart device, any electronic device that you have, from your smartphones to your laptops, they all have semiconductors in there. And we do invest in the world's largest dedicated semiconductor foundry. And this is a company that supplies mission critical chips to all the brands that you can think of in the tech sector that are in your daily life. So I just wanted to share very quickly what are the sort of companies that we can own, we do own. And for us, what we're looking to do is to look at companies with strong brand equity, meaning to say we want to have companies that are leaders in their individual spaces, right? So that we can buy them, hold them, and grow with them. So for us, we are also looking at companies that pay a dividend. We want to pay the right price, and we want to make sure that they are run by good management. For us, our turnover tends to be quite low because we want to identify the companies and we want to go in and we want to stay there. The turnover is quite low. For us, our portfolio has about a turnover of about 20%, which is about which makes the average holding period for each stock about 5 years. So it's a commitment from our standpoint. And like I mentioned, we are also quite valuation conscious. You're not going to see Dan Roberts, the manager of the fund, go into companies that have become so expensive or become what he thinks is too far away from the intrinsic value of the stock. If I can just share with you another example or rather I can go into further detail of one of the examples that I talked about, which is that, what I was talking about in terms of the, sorry, I'm trying not to mention the stock name. I got to remind myself. So it's a global provider of info services to professional sectors. And I have mentioned subscription model makes a lot of sense. But what's crucial is also that they are a diversified client. They are a diversified business. They provide materials, info to academics, meaning in the academia world, universities, PhD students around the world, medical, risk management, law. So for us, this is something that we really do like. And while I had to hide the stock name, we just wanted to show you how the stock has actually performed pretty well. We bought the stock, which is the one in blue, when it was doing badly. And like I mentioned, that's the time for us to pull the trigger, and then we can build our position from there. And this stock has done really, really quite well for us. So investors in our fund have been quite happy with this one. Another one that we really quite like, and you can probably guess, I think, which company it is based on what I'm going to share. Another example of an exciting company that we own would be a global fast fashion operator. They are very, very present in Singapore and in the region here. They have a very good global footprint. This is the biggest fashion operator in the world, and brands that they manage and they own include Zara, Massimo Dutti, Pull & Bear, Bershka, fast fashion that you would find everywhere. And what is quite interesting about this company, I was just reading the report earlier, and this company is mostly run out of Spain, but they have a very different sort of business model compared to their peers. And it's a relatively new position for us. Like I said, our turnover in the portfolio is quite low. And our fund manager and our analyst team did literally visit the site, did go to their factories, did go to the source, and did meet with senior management in the last couple of months at the HQ, which is based northwest coast of Spain. So we have a report from there. We've admired this company from afar. It is really a best-in-class sort of operator. But going down to be able to get a sense of what their product lines are, from their design to in-store, speed to market, compared to what most of the competition can do, these folks can move what's on the runway or what they spot as trends to the market in a matter of weeks versus months. They're also an extremely well-run company as a clothing retailer, and we do expect a very long runway for growth for them. And as you can see, the stock was also underperforming. So that's when we typically find names that we like quite interesting when they are cheap. And the stock has also done quite well for us. And the dividend that they're paying is currently at 3.7%, with a 5-year dividend growth of about 10% per annum. So for us, that is also really quite attractive. As I've mentioned, we are committed to paying our dividend. This is a dividend strategy. I'll give you a bit more details on that in a little bit. So if we're looking at what's Fidelity's approach, right? Earlier, I talked about how Fidelity is structured. Why are we different from the rest? Maybe now I can just go a little bit into the fund per se. So we're here to talk about dividend investing. Now, there's many ways to do dividend investing, right? And I've already shared why dividend investing makes sense for a portfolio, not just now, but for the longer period, as a core building block in any investment portfolio. This fund for us here, like I said, is one of our flagship strategies. It is truly a best in class. It is very widely distributed and it is very widely held. The fund size is at about almost nearing 13 billion. in size. So I can remember when I first joined Fidelity, the fund was almost brand new, and now it's really grown in size. So what is the goal? Like, what are we trying to do, and what are the benefits, and what are the sort of key points of this fund? Number one, it has been able to provide a growing level of income to investors. So currently, you can expect a annual dividend from this fund if you buy into the share class that pays out a dividend, about 3% per annum. Now, when we first launched, it was slightly north of 3%, but because the NAV, meaning the price of the fund, has been going up as a fraction, it looks like the yield number is coming down. But from a dollar perspective, we've been able to actually increase our dollar amount of dividend almost every year. In fact, I think every year we've been able to increase the dollar payout. So as an investor holding, let's say, 100 units of the fund, not buying into more units, investors have been able to actually get a higher payout dollar amount every year of holding the portfolio if they buy into the income paying share class. There's also an accumulation share class. Some people don't need a dividend, they just want it to compound. So that's one for income investing. For passive income, this portfolio, this fund checks the box in there. Another thing is that what we are trying to do is our process, right? What is our strategy? We're looking to invest in quality companies at attractive valuations. Now, I mentioned this quite a few times, so by now I hope this is not new information to you. We have very much a quality bias. So what we are trying to do is we do the research, we do our homework, we buy at the right price, what we think is a good price to hold for the next 5 years or so. And we want to make sure that companies are high quality, right? Meaning strong balance sheets, strong free cash flows. That means they have enough free cash to pay out dividends, a commitment to increase the dividend, and of course, a global business well run with good, strong, stable company management. And last but not least, our fund is a very strongly credentialed fund. Typically, he wins a lot of awards, and he has won a lot of awards for this style of investing. If you're looking at performance ratings, he's got top quartile rank over many standard time periods. So you can rest assured that you are getting a very well-run fund with a very highly regarded dividend investing manager in Dan Roberts. So on to performance here, and typically when I show this chart, there will be some questions. So if you look at the fund performance, this is since the start of the fund's life up till end of July, right? This slide is not updated for August data yet because that is quite recent. But if I can share with you year-to-date performance, the fund has done north of more than 18% total return, outperforming the index of the fund year-to-date. If you look at the lines here, right? The blue line is the fund performance since launch. The orange line is the index, which is the MSCI All Country World Index. We've chosen a global index which includes dividend stocks and non-dividend stocks, just to give you a sense of what the market is doing, right? But the index actually owns a lot of non-dividend stocks. Your Max 7 is in there. A lot of your tech names are in there. The fund, like I mentioned, is only holding dividend stocks and does not hold any of those Max 7 funds. So I bring this up because oftentimes a lot of folks tell me when you look at this chart, they say, oh, look at the performance, right? There's a long period of time in the last, since 2020 until now, the gap of the performance has been so large. And the answer is yes, there has been underperformance of the fund versus the index, let's say in the last 5 years, because of very clearly, we were not holding a lot of these high growth, very expensive tech names in the portfolio. Not because they are no good, but because they do not fit the process and the profile of company that we want to own. Therefore, we lack the index. But if we are looking at the fund on an absolute perspective, whether or not you make money, yes, you make money. So if you own the fund in the last 5 years, you would have made 7.5% per annum. The index made about 11% per annum. But if you look at what, like I mentioned, the benefits of investing in dividend stocks and in portfolios such as this, what are the benefits? You get a much lower risk profile. So if you look at the column on the right, what is the 3-year standard deviation? That is a technical term for what is risk. How risky is the fund? And you will see that the fund's risk profile in terms of the volatility over the last 3 years, if I stretch it 5-year, 10-year, it will look just as good, maybe even better. The fund has actually been able to give you an absolute amount of performance of like 7.5% per year, however, at a much lower risk. We are about 300 basis points less in terms of the risk we take. So that's sort of what I'm talking about here. We're not saying that these tech companies are not good. We're not saying it's not good to invest in the Max 7. We're just saying it doesn't meet our criteria. They don't pay a strong dividend. A lot of them are cash burning. A lot of them are also very highly priced, so that's why we avoid them. You can get your exposures there through many other channels, right? But this core dividend investing portfolio would not own this sort of stock. Hence, over the last couple of years, since the post-COVID rally, we have underperformed the index. But if you look at the yellow line, you will see that we have far outperformed the peer group. Now, what is the peer group, right? The peer group are dividend-paying strategies such as us. This is a best-in-class product for this sort of investment style. What is our investment philosophy? We sort of make it very succinct here, and I don't think I need to labor the point because I've talked about this quite a lot. We are looking at companies that are attractively valued. You know, if you think about what is a valuation conscious style, you can just think about, I guess, one of the most famous investors that we know that's still alive, Warren Buffett. Warren Buffett has a sort of valuation conscious style. So Dan Roberts subscribes to that. You know, very simply, he wants to do his research, he wants to buy a good company, but he doesn't want to overpay. Bringing me to my next point, better quality company. I've mentioned this a few times. We're looking at strong balance sheets, strong free cash flows, low debt, good management. And of course, we also want to make sure that, you know, they're not flouting any of the sustainability rules, right? Like slavery, poor care for investors, polluting the environment. Yeah, we also try to avoid companies like that in this portfolio. And as a firm, we avoid that too. The third thing would be we're looking for companies that pay a consistent dividend. Meaning to say, if the company does not pay dividend, we will not own the stock in this fund, in this Fidelity Global Dividend Fund. We're looking for consistent dividends. We're looking for good dividend growth and commitment to that growth. So we have no sort of benchmark to say, oh, we only buy into companies that pay a dividend of 2.5%. No, that's not the case. We have companies that own that pay out maybe only 1% dividend, maybe even less than 1%. And we have some other companies that are paying higher amounts, 5, 6% even, maybe even 7%. But on average, we just want to make sure we see that there's commitment to that growth and stability of that dividend, so we can pay out the dividend to our investors who want to receive that regular dividend. For us, we are not just focusing on cyclical stocks, we are mostly focused on defensive value, but we do own a good amount of cyclical stocks as well, which I'll show you later. Performance profile of this sort of fund, you will see a lower drawdown, meaning you will see less volatility when things happen. And that is, I think, top of mind for a lot of investors. Number one, as growth slows down. And number two, as we think of our portfolios in a holistic sense, having a core portfolio that is less volatile is always quite useful. So the fund, if I need to sort of profile the fund, right? As I mentioned, this is a bit more of a defensive fund. It's a dividend paying fund, but there is an element of cyclicality in the portfolio too. Meaning to say, there are parts of the portfolio that do and that does and has benefit from strong markets when there's growth. We do expect defensive to do better, but I just want to just share that this is not just a pure defensive portfolio. So if you look at the color on the donut chart here on the left, about 1/3 of the portfolio is invested in cyclical companies. So you've got materials there, you've got autos, you've got some IT, you've got media companies, discretionary, retail, consumer discretionary companies in there, and some financials, some of the asset managers, which are in the financial side. On the blue side, which is the majority of the portfolio, would be a bit more on the defensive side. Things that are a little bit more reliable, a little bit more boring, a little bit more resilient when growth slows, when things happen. We do not have exposures to the sectors on the right-hand side, meaning to say like I mentioned, the Magnificent Seven. We don't have any exposure there. We do not have any exposures to banks or life insurance. We do have exposure to insurance that's a lot more stable, a lot more easier to predict, and that is your property and casualty insurance. You know, companies that insure cars, buildings, fire, every year, sort of subscription model. You drive a car, you got to buy auto insurance, right? We don't own any energy companies or mining companies because we do not like the drama that comes with oil prices. It's extremely hard to predict. So we just avoid that. And we also don't own any REITs. Now, going back to this point, just to wrap up before I open the questions, here is the evidence of a share class that pays income, and we have been able to increase that income every single year in the terms of the dividend rate. So while the yield can fluctuate, because that's just a formula, the actual dollar amount for our investors in the share class paying the paying income paying share class, excuse me. We want to have that slide in there. We want to have this slide in there to just show you what's going on. Why not REITs when markets expecting a good dividend? Well, I actually say there's a lot. It's not that we will not own REITs. We could, but we would rather see opportunities elsewhere because we do know that the REIT market is quite well invested, and some of them are also have also been quite expensive. And REITs from time to time they can be quite volatile. So we are staying away from that, from his investments philosophy perspective. Not that he cannot own, but at this point he doesn't own any. Like I said, there's a time where we might have some, but at this point that there's zero exposure. Summary of the fund here. Number of holdings we have is typically between 40 to 50 to 60 holdings. So quite a concentrated portfolio. Hence, we want to make sure that we don't trade too much. We are quite committed to holding a stock at the right price for a longer time. And if you're looking at the maximum position that we have in the portfolio, typically we don't go past 5%. Currently, the maximum stock position is less than 5%, about 5.4. We do have a cap for risk management. We will not go more than 25% in any sector or any country, I think, for that matter. And if you're looking at active money, which is very important as an active manager, you do want to find active money, meaning how different is this portfolio to the index that we are sort of comparing ourselves against. The fund is 95% different to the index. So for a lot of clients who say, oh, I want to buy an ETF, a global ETF like MSCI. Am I getting something different when I buy into your active fund? Answer is yes, because the fund is 95% actively different from the index. Yeah, as I mentioned, portfolio turnover is very, very low. Our portfolio turnover is about 20% lower end. And that means our holding period is anywhere from 3 years to 5 years. But it's been more like 5 years over the last 5 years. So with that, I'm going to stop and open up for questions. So Daniel, over to you.
Okay, thank you, Jonathan. All right, so we have a couple of questions here. Okay, someone is asking, right now it seems that the pharmaceuticals...
Hi, Daniel.
Hi, can you hear me? Hi, can you hear me?
Daniel?
Yes, can you hear me?
Oh, never mind. I seem to have lost Daniel for a while. Maybe I could just open and see if in the last, in the last couple of minutes or so, 5 minutes, 10 minutes, are there any questions that you'd like to put through in the Q&A? I'll do my best to answer them if you have it. Poems has a few of this unit trust, which is the one that I should be looking at. So the name of this fund is called the Fidelity Funds Global Dividend Fund. So you can see on this, if you can see my slide, this is the name of the fund. There are, maybe I can just correct or clarify what you're trying to say. You might be saying the fund that there's a few share classes. So there's only one fund, but there's several share classes, right? You might see A, Mincome, ACC share class. Which one should you be looking at? Now, this is something that I would say you can check with Philip, but I can give you a quick summary because I'm not sure exactly what you are looking for, right? but there will typically be different share classes in different currencies. So whether or not you want to buy into a Singapore dollar share class or US dollar share class, and the next decision would be, would you like to have regular dividends, or are you looking just to accumulate and reinvest the dividends? If you're looking to reinvest the dividends, then you want to buy into an accumulation share class, ACC. And if it's SGD, if you want regular dividends, then you want to go into the like a share class that says it's got M income, right? M income at the end, and look for the SGD share class. I hope that clarifies. But this is just sort of like the different share classes. Very easily answered if you just check in with Philip. Yeah, you're welcome, Miss Yap.
Hi, Jonathan.
Just to be clear, it's the same fund. Regardless of what share class you buy into, you are the monies you invest will go into the exact same fund. It will go into the hands of the fund manager, and you will be buying the exact same stocks, the same portfolio in the same proportion. Yeah, cool. Daniel, are you back? I'm not sure if you can hear us at all.
Yes, Jonathan, I think, can you hear me?
Ah, looks like I've answered. I've delivered a pretty decent presentation, because there's not that much questions, or at least I'm not seeing that it's coming through on the Q&A. Okay, so maybe I can just do a very quick summary of what this product is. Really a very simple product. The hard work is done by the analysts. The hard work is done by the fund manager. It's very simple. It's a core global equity product that we have created to sit in an sit in an investor's portfolio as the bulk of equity, the bulk of the equity allocation. That's what we designed it for. Whether you want it to be a core part of your portfolio or a small part, it is completely up to you, because it depends on your risk class, your appetite, and your individual life state. But you can actually use this to get a good exposure. It's very much less volatile than the index. It has been able to deliver very strong returns over time at lower risk, and you get a dividend along the way. I've got a question here. What is the top 10 holding of this fund? So you could easily go to our fact sheet to find this information, but I can rattle off the few because I have them in front of me. So our positions do change regularly, because markets move and all that. But as of the latest fact sheet, which you can find from many websites, and I think the Philip website has it too, or Poem's website has it too. Top position right now is Unilever. Unilever is a consumer staples company. You would know all their products if you just do a quick Google of who Unilever is. So going back to that stable dividend paying consumer staple, come rain, come shine, good times, bad times, you buy products from Unilever. And it's not just pure consumer, they also supply to businesses, right? Second would be Deutsche Börse. So Deutsche Börse is a financials company, and it's not Deutsche Bank. I do get this question quite often. Deutsche Börse is the German stock exchange. And we like stock exchanges as part of the financials sometimes, because we have when you have volatility in the market, stock exchanges make money because they're there to just take trades. And with volatility, there's a lot of trading that happens. So Deutsche Börse, just like like SGX, but it's a much larger market. Deutsche Börse is also there, and they pay a very decent dividend. We've held this position for quite some time. Maybe I can also share that Unilever in the index is only like 0.2% of allocation, but we are about 4.7%. So we are really quite we're holding more of this portfolio compared to the index. Same for Deutsche Börse. The other company that we own, number 3 position, is RELX. Now, this is a professional information services provider that does medical journals, legal journals on a subscription basis. You might find this a little bit familiar from what I said just now. 4th position is a Asian name. So this is a global portfolio where we can also own stocks that are, of course, in Asia. TSMC, Taiwan Semiconductor Manufacturing Company. We own this is our fourth largest holding. We do like the company. We do find that they are stable. And we did buy them at a pretty good price. So we're quite happy with that. I won't go through the rest in the interest of time, but if you just open our fact sheet, you'll be able to see the top holdings there. With that, I think we are running very short on time. Maybe I can just do one more question, which I see. Saw from Poem, last question here. If invest in USD versus SGD, USD has higher returns. Okay, so it depends. So if you are buying into a US dollar share class, you are, of course, going to have to exchange Sing dollar to US, right? So you are buying US, and if US dollar is expensive, you also have to factor that cost, which I won't be able to tell what is your exchange spread, right? However, if you look at the performance over time, if I just look at a very simple, since let's say 5 years, okay, since 5 years, the last 5 years, if I compare the M income Sing dollar share class with the M income US dollar share class, Sing dollar share class has done 7%. US dollar share class has done 7.5% on an annualized basis. So there's a 0.5% difference in performance. Not large. Over time, it does tend to even itself out a bit more. But the reason for that is because when you are investing in a Sing dollar share class, you are actually taking some currency risk. Your investment is also being there's also some impact to the currency, because there's a lot of different currencies in a portfolio, so that it's translated. So there's some foreign exchange risk in there. However, if you want to take away that foreign exchange risk, there's also the share class called the Singapore dollar hedged share class. It starts with H, right? It starts with H. In the share, it ends with H. Sorry, you will see a Sing dollar hedged share class. If you want to take away all this risk in terms of currency, you can invest in the hedged share class. And the hedged share class, if I look at the last 5 years, it's at 8.3%. So M income SGD hedge share class is at 8.3% versus the USD is actually done a bit better because we've done some hedging, so we're taking away the currency risk. What is the dividends like from Mr. Low? This question. Number one, this is about, you can call it about 3%. Like I said, the yield will shift depending on the price of the price of the fund, the NAV of the fund. But you can say safely it's about 2.8% at this point on an annual basis. Yeah, so another one, is it safe for retirees? I wouldn't be able to answer this question directly. I think it's best that you need to do your risk profiling and whatnot. So best that you find out. But I do see that it's a less volatile, because it's a less volatile investment in the equity space, right? It's less volatile. You, as compared to investing in a single stock or just the three tech stocks, for example, I would say that a portfolio that's diversified, it might be more suitable. It might be. Yeah. Expected upside if we buy now, the increase was 12% since January 2024. So we are long-term investors here. It's very hard, and I can't predict what is the expected upside. I really can't. It'll be wrong anyway. It'll be too high or too low, right? But I can share, if you look at historical performance since the launch of the fund has been able to give in good times and bad times between 8 to 10% overall on average on a per annum basis. So there will be always volatility up and down, but if you're expecting, like us, growth to slow in markets, we're expecting, but not expecting a crash. We're not expecting a big recession, but people are going to be a bit more careful. People are going to avoid higher valuation stocks and look at things that have good value. I would say this portfolio is a lot more better positioned for the medium term as compared to going to something that could be potentially a lot more volatile and that probably has run up in terms of price a lot already. Yeah. We've actually overrun, so I have to apologize. I need to run out for a next meeting very soon. Daniel, may I just check if you are still online?
Okay,
because I couldn't hear you earlier for the
I think,
last 10
Jonathan, you were not
minutes.
able to hear me, but I think the audience is able to hear you. But nevertheless, thanks for the wonderful webinar.
Sure.
With that,
Anyway,
mm,
everyone here who's attended, taken the time, thank you so very much. I think there's about 20 plus of you who've taken the time to attend. I really hope this was useful. I hope you sort of get a sense of who Fidelity is, how we are different, give you an update on what's going on in the market, and I give you a sort of sense of what dividend investing is and how we do it through the Fidelity Global Dividend Fund. Stay safe, don't get caught in the rain, and I'll see you around. Cheers.
okay, thank you everyone.